here we go. Okay, you guys, this is being recorded, and of course you guys know that because I'm talking about it right now. And one thing I mentioned, it's watch this again. Whether it's this one here on the short put spread or one of the other ones I've done, you know, we're attacking this one a little bit different. So if this doesn't really resonate with you, check out one of the other short put spreads. The reason why I want you to watch it again, you guys, is because it'll sink into your long-term memory some of these nuances I'm talking about that you really won't find online. Let me try and change that a little bit. The first time through, especially if you're new to options trading, it's gonna kind of get maybe a little fuzzy. Second time through, it will really sink in, and I think you'll understand it a little bit better. And further, if you are an options trader and you've traded a few times, I have specific rules or specific guidelines that I use to follow down this path to finding the right option strategy. Usually what we're doing on a day-to-day basis is looking at charts, looking at the news, and trying to find opportunities out there. And when you find an opportunity where you are bullish in this underlying, for whatever reason, we kind of don't necessarily go out there and buy a call or sell a put on any given day. What we need to do is figure out if that environment around that underlying that we have this bullish assumption in is right for a specific strategy. So what I'm doing with this particular webinar course is that we start out with a bullish assumption in something, and then we kind of play along the lines of what we do going through a day-to-day basis to find the right strategy for that given assumption. So we came up with the roadmap to trading options here, which is this particular course. And today, yes, we are talking about the short put spread. I can't just leave you guys in the lurch until the very end, right? I wouldn't get anybody probably showing up. So we are going to do it on the short put spread, but kind of put that on the shelf for right now, and we will get there again. So I'm going to kind of play it out like we're going through the steps here. All right, let me get a couple things out of the way real quick. I'm Eric Wilkinson, and you may recognize me from mainstream media where I've talked about the economic, geopolitical, and my market analysis. I do the same thing in daily market commentaries, not so much here in these webinars, but I've been doing this for over 25 years and kind of streamlined the process of trading options that I hope that you guys will be able to follow along here. In that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in all market conditions. You can follow me on Twitter at Wolfman's blog, or our parent company at ProTrader Strat. Also, our parent company is at ProTrader Strategies. You can follow us on Facebook as well because we throw out all kinds of content on there. Like I mentioned, I do daily market commentaries where I'm talking about my specific trades and the option strategies I put on for my assumptions I come up with on a given daily basis. So you can follow that stuff and get that content on ProTrader Strategies, as well as some of our other affiliate educational people. So check us out on Facebook, give us a follow, and, you know, thumbs up if you like it. Best thing you guys can do for us is, or do for me, you know, as a show that you like it, is tell somebody about it, you know, help somebody else out with trading options. It's really the best way to increase that overall yield in your portfolio over and above even just buying stocks, because there's always an opportunity out there for other directional moves. All right, this is on the short put spread, and I see Thomas is throwing out there. I thought this was on naked short puts. I hope I didn't screw this up. I think that next week is the naked short puts, because what I was trying to do is expand on risk parameters here. Start out with lower risk tolerance with the short put spread, and then we expand on that with the naked short puts next week. Okay, Thomas? And everybody else who thought that it might be this week. All right, perfect. Yeah, we'll talk about, even next week, I'll talk about the benefits of doing a naked short put over a short put spread as well. So maybe watch this one, and then we'll see, you know, the risk parameters and the quote unquote higher risk of a short put next week. And I'll explain why I don't know that it's really considered a much higher risk tolerance. But when we're doing a roadmap, we need to talk about our roadmap key, and that is the, it is the Greeks here. I don't want to run you guys off or scare you guys off. A lot of people like to try to avoid this aspect of options, but I'm going to try and make it real easy for you guys by just laying this out in layman's term for the most part. You know, delta is something that affects that option premium in relation to the underlying. So when we're looking at a option montage, which if you ever hear me talking about the option montage, then you're going to hear me talking about this page right here, where it has all of the different months and or the different expiration cycles. When I usually talk about this, I'm going to go straight to 35 days to expiration. That's usually where the most time and volume's been, or the most volume and open interest is on any given underlying. It's the sweet spot, if you will, of volume and open interest. And what it really will tell us is a lot of things. Is there participation going on in this underlying? And you want to look at this during open market operations to fit most of my guidelines. After the close, we see all kinds of orders canceled. The bid offer gets really wide. So that makes it seem like it doesn't fit some of my rules sometimes. But anyway, we're talking about delta over here. And what we're saying is delta affects the premiums for a move in the underlying. So if we're talking about $1 move, and remember, delta, all of the Greeks assume one move in advance or higher in a sense, okay? So what we're assuming here is Facebook is going from 261.30 to 262.30, okay? So we're just saying $1 move higher. All else we're trying to separate out of this. So assuming nothing else happens, you know, time doesn't pass, the days don't go by, volatility doesn't change at all. So what this would be saying is that our premiums for $1 move higher in Facebook, our corresponding calls here, the 265 calls, would increase by 47 cents. So now we're looking at the bid being right around $10, add 40 cents into 970. So we're looking at $10.27 or $10.17 on the bid and $10.47 on the offer. So that delta increases the premium by that corresponding delta, 40 cents to the 270 calls, right? These are the 270 calls. Then if we had a dollar move higher in the underlying, our premiums on these would increase by 40 cents. So we would have $8 bid at $8.30 offer, okay? Vice versa, on the put side, you can see that delta is negative. Again, that's because the assumption is a dollar move higher. And when you have a plus, minus, or plus a positive, plus a negative, that means it's a negative, right? So in this case, if we looked at the 255 puts, a dollar move higher in the underlying, our premiums would decrease by that 39 cents, okay? Vice versa, if we had a negative dollar move, right? So now we're at 260.30. Well, then the delta on the put side, a negative plus a negative makes it a positive. So that 39 cents would then add into the puts, okay? Or the corresponding delta. On the other side, right? A negative plus a positive makes that a negative to those corresponding premiums, okay? Pretty simple so far, right? All right, so that's delta. Delta affects the premium in the underlying. It also tells delta, the easiest way to remember delta is its data also. It gives us probabilities of being in the money at expiration. It gives us the probabilities of that strike being touched during that expiration cycle. So it does tell us a lot of things. I'm not going to go into all of the details of delta and the data it produces. I have some quick little videos that you guys can check out at Pro Trader Strategies to find out some of those. It's like 5 different things that delta will tell us. So it's a really important one. But for this, we're just going to be talking about how it's going to affect our premiums most of the time. All right, easiest way to remember gamma. Gamma goes with delta. So when you're looking at gamma, just remember, hey, gamma goes with delta. And that we talked about, delta was the first dollar move, right? It's dollar number one. Gamma is dollar number two, all right? It's number two, and this is number one, all right? So first dollar we talked about, delta adds into the premium. Well, on that second dollar move, then our gamma is going to add into that delta. So when we're looking over here at the option montage, we can say that, you know, dollar number one, we talked about this, it went from 261 to 262.30, right? And we talked about what the premiums went. So that 47 cents went into those premiums, and we were looking at $10.17, and the offer being $10.47. Okay, and that's on this strike right here that we're talking about. Now we're talking about the second dollar move. Now we're at 263.30. So now gamma, which is this column, it goes into delta for that second dollar move. So now we're looking at 48 cents, right? $1 going, or 1 penny going into that 47 cents. That's 48 cents adding into our premiums on the next one. So now on that second dollar move, we could assume that our premiums are going to be $10.65 on the bid and $10.95 on the offer. All right. And I'm doing the math in my head real quick, so I might be off a little bit there. And on the flip side, when we were looking at the premiums over here, the same thing happens. On that second dollar move, we've got a negative here, right? A negative 39 cents and a positive gamma. So on that second dollar move, negative 39 plus a positive 1 penny makes it negative 38 cents. So then our premiums on that second dollar move higher on the put side would only decrease by 38 cents. All right? Does that make sense? And vice versa, on that second dollar move lower, we've got the negative dollar plus the positive delta. Now that second dollar move higher, or sorry, that second dollar move lower, that negative is a positive. So we have 39 cents plus a 1 penny. So our second dollar move lower, our premiums would increase by 40 cents versus the 39 cents. Okay? Does that make sense? A lot of sense. A lot of sense depending on your S and your C's. All right, so delta is data. Delta also tells us the first dollar move. Gamma goes with delta on the second dollar move. All right. And then we have theta. Theta is the impact of time on our premium. Now, theta, we're going to notice, is also positive because, or sorry, theta is not positive. Theta is going to be negative across the board on the calls and the puts, right? Because we can't go back in time. We can't negative a day. So every day that goes by, theta is the thief in the night that comes and steals our premium, all right? So the way to remember theta, it's the thief. It always is stealing premium every single day. And the closer we get to expiration, the closer we get here, we can see that theta is much more aggressive, all right? So it is inside of 8 days, it's almost double, right? It is double inside of 8 days from when we were at 35 days to expiration. And if we go way out here in time, like 90 some days, it's going to be much less than the 36 days, what I wanted to close out. So you can see another 5 cents per day inside of 35 days to expiration. So theta is not, that thief is not very aggressive way out the time horizon, but starts getting very aggressive the closer we get to expiration. He's like, all right, this thing's getting ready to leave. I need to take as much money as I can out of this. And that can be a good thing, right? Like if you sell, if you are shorting, you want theta to help you out. You're kind of like, I'm leaving the door unlocked. I'm opening the door for this guy. Come on in, you know, take all the premiums you want. So we want to take advantage of theta sometimes. Sometimes we want to minimize that. You can never really completely stop it. Yes, you can offset it by doing a spread, right? If you buy one and sell one, or sell one and buy one, option strategy or option strike, then yes, you can kind of limit it or offset it, right? Because the one you sold, you want the theta to take away, and the one you bought, you want to kind of limit that. So you can play around with it. We'll talk about that a little bit further on because we are doing a spread, right? We're buying one and selling one, so we are going to be able to limit it a little bit. But you can also see that the closer to the at the monies on the calls and the puts, that theta is much higher, right? So when we're selling a put spread, we're going to be selling one that is much closer to the at the monies, which means it's going to be more aggressive. That means it's going to help us. So we want to kind of take advantage of theta in that regard. So theta is the thief in the night. So tomorrow, 15 cents is coming out of these premiums, the 260 puts. All else stays the same. Facebook is at 261.30. Tomorrow, if nothing else changes and the volatility doesn't move, then our premiums will go down by 15 cents on the calls and or on the puts and in the calls. All right, 16 cents over here. All right. So theta is that thief in the night that comes and steals our premium, if that helps you. All right. I've got a dog trying to peek in here, I think. Vega. Vega is the only one that's really not quote unquote a Greek. And I have a Greek symbol down there, but I stole it from another Greek because it is looks like a V. So Vega measures the change in volatility. So Vega goes up and down, but again, the assumption here is that volatility is going to increase, okay? So like I said, days go by, the underlying goes up, all of those things go by, volatility increases. So when Vega, which is in this column right here, goes from 38.89 to 39.89, so now we go to 39.89 here. We look at the calls and the puts. You can see Vega is positive because it's assuming that one percentage point higher. And if it increases by 1 percentage point, then we get 33 cents going into our calls and in our puts, or the volatility coefficient goes in there. All right. You know, $2 or 2 percentage point increases, then it would be 66 cents, right? 10 percentage point increase would cause it to increase by $3.30. So when I'm talking the Greeks, yes, delta is important. It's data. It gives us a lot of information. Volatility, though, is the one that has to be top of mind, you guys. It's the one that we are really the most concerned about because we're buying and selling options premiums, right? And if it is the one that is probably going to affect our premiums more, that's the one we need to understand. Yes, an underlying can move by $1.40 some a day, which means that this premium probably, our strikes here probably increased by about 60, maybe 70 cents today, right? But if the volatility increased by just 2 percentage points, well, we would have a 60% or 60 cent increase there. And we see volatility fluctuating quite a bit on any given day where, you know, 2 or 3 percentage points moves in volatility, especially right now, is pretty big deal. We can see the Facebook from basically yesterday to today going from 42 to 38. That's 4 percentage points, right? We talked about a $1.40 move. That was about 70 cents. We've got 4 percentage point move here in just one day. Well, 4 times 33, we're looking at about $1.32, right? So that volatility move is much more concerning to us than maybe even the underlying moving around on a lot of times, okay? So volatility is something we really need to understand, which is why I want to spend some time on these roadmaps. I mean, it's pretty easy, though, to think about it. Vega, though, if you guys watch many of my daily market commentaries or any of my videos or my webinars, you guys know volatility is probably something I talk about more than anything else. Yeah, I brush on theta and delta. You know, I kind of leave gamma off of it a little bit because gamma really affects your premiums closer to expiration, and that's usually when I'm out on when they're starting to get really close to expiration. And we talked about theta is less way out on the time horizon. Well, vega is much more apparent the closer to expiration here. So, sorry, further out on the time horizon, volatility gets much bigger. So you can see vega out here, 100 days to expiration, is 55 versus 33. So volatility affects the further duration options more than the nearer duration options, okay? So if you want volatility to really take hold, you could start to look out there on the time horizon. I want to kind of get the sweet spot, the best of both worlds. When I want to take advantage of volatility coming out, well, I'm usually going to go to the nearer durations because if I expect my move to be right, I want to take volatility and delta in my favor. So usually when I'm selling options premium, I'm going to nearer duration. When I'm buying options premium, I want to limit that theta decay. I want to take advantage of the delta moves, right? And I want volatility to expand. And when that volatility expands, it will really help me out, okay? So I'm looking to get all of these Greeks in my corner, all right? I want them to help me out the most they can, all right? So a little touch on what we're doing. So now that we've got our keys, our roadmap key taken care of, let's get on with it. First thing we do when we're going on a road trip, most people spend more time planning a vacation or a road trip than they do on their financials on any given year. So that's why we came up with this. We're going to go somewhere, and we're going to go to GLD. All right. So I'm going to head up to here, or I don't care where it is. Maybe it's St. Paul. GLD is where I'm going. All right. This is something that I've come up with as my assumption. And why did I come up with that assumption? It doesn't really matter, to be honest. You know, if you really wanted to press me on why I'm bullish, or I believe that GLD is here from where we are here, then I have to say that, well, before today, and they walked away from the table and said, you know what, you guys can all wait on your stimulus package while we go on vacation. The idea was another stimulus package was like imminent, and that would devalue the dollar even further. And gold and the dollar are pretty much inversely related. Yes, we could go back and forth, but theoretically, as the dollar weakens, we see strength in GLD and dollar denominated assets. So for me, I am overall bullish in gold, bullish to neutral even. You could even be neutral, which is kind of where I'm at. I do believe 2000 is going to be kind of the thing that we see going on for at least the next couple of months. I think gold is going to stay at elevated levels. Do I think it's going to 20,000? Not necessarily, and not in the time frame that I'm looking at. So the next few weeks, I think that gold is going to traverse a little bit higher or stay sideways. That's my theory on gold. So with that being said, I need to find an option strategy that fits that bullish to market neutral type of strategy. I'm worried about the upside. I'm not necessarily worried about the downside, but I do want some protection down there because, yes, if they do go on this hiatus and don't get a stimulus package out there and the economy starts like being crummy, people could start pulling money out of gold and things of that nature. And everybody else, like China, just started talking about doing their own quantitative easing. Well, if the rest of the world starts debasing their currency and we don't, then that gives us strength to our dollar, which would then cause gold to go down. So you know, those are things we always come up with, right? It's not always completely bullish. And I'm trying to lay out a scenario where, yeah, I'm bullish in gold. I think it might trend sideways, but, you know, if we don't race to debase with the rest of the world, then we could see gold come off a little bit as that dollar strengthens. But overall, I am kind of in this camp where I am bullish to market neutral. I'm, you know, I'm kind of thinking, you know, it could stay neutral, but overall, I want to take advantage of this bullish move I believe is pretty imminent. So, you know, that's how we kind of lay out our roadmap, right? We come up with these assumptions based on economic, geopolitical, or our market analysis. And in this case, it's kind of my economic analysis on what is going to happen going forward. And I'm kind of bullish in gold, but a little bit concerned about the downside if we don't race the debase. So bullish to market neutral. So if we're here and I want to go up here, I'm kind of thinking, okay, well, I think the market could do this and then kind of travel higher, right? So that's my scenario. I do believe we need to go north in gold, but that whole sideways trend, how can I take advantage of that type of move? You know, I mean, I do believe it's going to at least stay elevated. It could come back down a little bit, but I do want the overall market to move higher. John says that he's losing audio. A best thing to do is, and of course, it's not going to help John, but if you guys ever are on one of these GoTo webinars and you lose audio or the video keeps cutting in and out, the best thing to do is log out and log back on. So that's the best thing to do. Thomas says China needs to debase to keep up with other currency manipulators. Well, absolutely. I mean, that's the thing. It's funny. It's like everybody, it's a race to debase, right? Ever since basically, well, it's been going on for quite some time now. Everybody wants a weak currency. All right. So next thing is, I believe we're going to gold or going to St. Paul, Minnesota. Not a place that I necessarily have as a destination, but we've got our destination picked out and we're picking out our road trip. Now I'm kind of thinking, all right, well, is GLD a good thing to play around with? Well, what we're going to be doing is looking at GLD here on the option montage, and we're going to be going to 35 days to expiration for this rule. So you can already see I'm not trying to solicit you guys to buy this underlying. I've got a position in this. So full disclosure, I do have a bullish position in GLD, and Thomas is like, dude, you sold puts. This is a naked put in there. Yes, it is. And I talked about that in the daily market commentaries. I put this on based on basically the assumption I just laid out for you guys and talked about that in those daily market commentaries. But for this particular webinar, we're going to be talking about the put spread. All right, so do we have a good destination? What I mean by this is we need to look at the option montage here. And any stock that is trading over $100, all right, we look at this 35 days to expiration here, or closest to 35 days to expiration. You're not always going to be able to nail that number, but we're going to try and look to see which one is closest, right? And 8 days to expiration is way too short of a time frame. You know, I like to give myself at least a little room to be right. So with that being said, what we want to do is on a stock that is greater than $100. So if XYZ, doesn't matter what it is greater than $100, then we move the decimal 3 ticks. Let me get this up here. Greater than $100. All right, XYZ. It's greater than $100. Then we basically move this decimal 3 ticks to the left. So we basically have 18 cents. So I need this to be less than or equal to 18 cents in our option montage. On the this options that are right around the at the moneys, okay? The deeper in the money we go, the wider the spreads get. The further out of the money they go, they get a little bit wider also. But we're looking at the bid offer here on these calls and puts that are closest to expiration. And if it is less than or equal to 18 cents, that means we are looking at a, we got our stoplight here to follow along with the deal. So that would be a green light. Now, if it's 2 times the rule, then we have a yellow light. All right. And if it's 3 times the rule, then we got a red light. All right. That means it's probably not enough volume and open interest. Yeah, you can flip over there and look at the volume and open interest, but I would have to tell you, this is if you want streamline, that's what I try to do. As an options trader on the floor, we didn't have time to go every time somebody quoted something or every time there was a market given. Hey, what's the volume and open interest in there? Is there anybody quoting XYZ right now? What's the market? Well, bottom line is if there was one person in that pit, that bid offer was really wide. If there was a ton of people in that pit, that market gets a little tighter, all right? Because it's his bid and it's the other dude's offer. Whereas if there's only one guy in that pit, he's making both sides of it. And his market is going to be really wide. This rule or this guideline really kind of gives you a quick streamlined focus on whether there's volume and open interest. Tighter markets means there is full free market price discovery going on. Now, if the stock is less than $100, if we're less than $100, then it's basically, it needs to be less than or equal to 10 cents wide, okay? So any of these like down here that are less than $100, first thing is 10 cents wide or less, that's a green light. Yellow light, 2 times that, okay? So pretty quick and easy way to streamline your process when you're looking at it, because you guys are looking at different stocks than I do all the time, and you guys bring different stocks to me, like BILI, I think it's Billy or something. They're into 5G. That stock wasn't on my radar, but there it is right there, just above GLD. So that has pretty good market participation going on. I added it to my watch list because it fits the rule. It's a $41 stock, and during open market operations, you can see it's got pretty tight bid offer. I could flip over and say, all right, well, you could go over there. Does it have good volume and open interest? Yep, it does. Well, easiest way to do it is if there's tight bid asks, pretty much that it is fitting that rule, all right? Or that it's got pretty good volume and open interest like GLD has here. All right, so do we have a good destination? Well, I have a bullish assumption in GLD. I want to go north. Yes, GLD is a good destination for trading options, okay? All right, so we have a good destination. That means GLD is good. GLD checks off that whole list there, all right? Next thing we need to do is we figured out that this thing that we have a bullish assumption in is a good place to go. It's got a lot of volume and open interest. There's a lot of things to do, a lot of people there, so it'll be fun. Now we need to know, what is the environment in St. Paul, Minnesota? No, I'm not talking about what's going on in real St. Paul, Minnesota. What I'm talking about is on our destination to St. Paul, Minnesota, what is the environment around us heading up that way? Is it sunny, blue skies, nothing to worry about on our drive? Well, that would be low stress, right? Low volatility. Think about it that way. You can see forever. You could take your time getting there with low volatility, which means, if you have low volatility, that's where I was talking about earlier on. I want to get into that further duration because I want, when that volatility expands, to take advantage of that, right? Or do we currently have high volatility? And when you have high volatility and you're on the road and it's like whiteout conditions, or in this case, raining and just pouring down rain, that means volatility is high. Your stress level is high, right? I always correlate volatility as in the stress level. That's usually, it's a fear indicator. A lot of people will discount that it is a fear indicator, but it is. When people are going out there and buying calls and puts or whatever without regard, it's the feeling of missing out, and the stress level is higher, so they're not even paying attention to what they're paying for these things. Sometimes they're paying ridiculous amounts of money for options premiums for protection, or their fear of missing out, their FOMO. They don't pay attention to what they're paying for these pricings. So that volatility is a factor, or actually the premiums. I always say, is Black Scholes the chicken or the egg? Volatility, people going out there and just buying premiums, they're not thinking about Black Scholes, but that's driving volatility higher when they're paying up for those premiums. So stress, volatility is an indication of the stress of what's going on out there. And in this case, we can see volatility could be high. How do we know if it's volatility is high or low? What we're going to do is every underlying, we're not looking at the VIX. VIX does give us a good indication of the overall overarching volatility in the market, but VIX could be low and we could see this underlying have high volatility. So we need to drill down on this destination or this underlying we're looking at to see what its volatility is right now in relation to where it's been in the past, okay? So we use implied volatility, not historical volatility. We're using implied volatility because implied volatility, I like looking at forward-looking economic data points and signals for the markets, all right? And implied volatility is forward-looking. Historical volatility is looking back, all right? So I don't want to look at what has happened. I want to look at what the expectation going forward is, all right? So in order to do that for each XYZ or whatever underlying, I need to know a couple of things: where the current IV is, all right, implied volatility is, current IV is, and the low IV. And I also need to know where the high IV is. But what we're going to do here is we're going to take the current IV minus the low IV, and we're going to divide that by the sum of the high IV minus the low IV, all right? It's not a very good V, all right? So what that does is it tells us where we currently are in relation to what that range has been, all right? And underlyings or stocks usually have a pretty good high and low, a pretty good range where they kind of bump up and it's like it just gets a little bit high or frothy. Well, we talked about what volatility does to those premiums, right? As the percentage points increase, right, those premiums get higher. Well, we want to sell premiums when they're expensive and buy premiums when they're low. Well, the only way to figure out if XYZ has cheap premiums to buy or expensive premiums to sell is really this right here, all right? We need to know what this is. And especially right now, because we've just had this black swan event, one could say, in the pandemic, which has caused volatility to really spike, unlike we've seen since basically, some people could say 2008, 2009, but really the volatility spike hasn't been seen since like 1987, all right? And then before that to like 1929, all right? So that volatility spike is probably not going to happen for quite some time. So as we know, this high is added into that, all right? It could throw off our pricing a little bit. We're going to talk about in more detail as to how we're going to approach that, because right now, yeah, I have the script for you guys to throw in a watch list, and you can see exactly what implied IV percent is, right? That's what this all equals. We're going to need to fudge a little bit on it because I don't think we're going to see those all-time highs that we just saw. And I also believe that last year is probably, kind of needs to be discounted also, because I do think that volatility is going to remain relatively high for the rest of this year. So, we're going to have to know what this equation is in order to really know where our implied volatility is. And it's kind of up to you if you're going to fudge it or just look at the exact numbers. Does skew have anything to do with that? Now, skew does have something to do with the volatility. Usually when we see volatility spike, most of the time we see volatility get skewed to the puts because people are buying those puts like they're going out of style, right, to protect their overall portfolio. So usually we do see some skew to the puts in most markets. Sometimes in GLD, you actually see the opposite because people don't want to miss out on that upside move. So you see some skew to the call side. But no, skew is not going to affect my decision on my strategy necessarily. I don't care what everybody else thinks, Thomas. Which skew does tell you what everybody else thinks, whether they're worried about the upside. If they're worried about the upside, you see skew, meaning the equal distant call from the at the money. If they're skewed to the call side, that means people are worried about the upside, right? Because they're buying calls more than they're buying the puts. Skewed to the put side means equal distant call and put from the at the money. So let's just do XYZ as 100, basically 105 on the calls and 95 on the puts, right? So that's equal $5 up. This is the put side. This is where XYZ is, and this is the call side. So skew to the call side means these calls are equal distance from the puts. This call could cost you $2. Let's just say for lack of a better thing, $2 there, and these are $1.90, right? So what that would be saying is there's skew to the call side, meaning there's the overarching theory in the market, or the overarching market analysis would be that people are buying calls more than they're buying puts, meaning the risk is to the upside in that case, and vice versa. If the puts were $2 and the calls were $1.90, that means there is skew to the call side, or skew to the put side, meaning people are more worried about the downside in XYZ than they are to the upside. Okay. So when we're talking about skew, for some of those people, Thomas obviously knows what skew is, but if we're talking about skew, that's what we're talking about. And it also does something to the bell curve, which I'm going to talk about here in a little bit. I got a little ahead of myself there. So we need to know that equation, because why does volatility matter? Because I mentioned this, right? When volatility is high, we want to sell premium. When it's low, we want to buy premium. So what my rule is here for volatility, and I might be getting ahead of myself here again, but when volatility is high, we want to sell premium. What I'm talking about, when IV percent is greater than 50, all right, we want to sell it. And for an ETF, this is for a stock, and for an ETF when it's greater than 30, all right, we want to sell it. And for a buy, if it's less than 50, we want to buy, and if it's less than 30, we want to buy. All right. First, this is stock and ETF. Right. Now, if you have a lower risk tolerance, or you're brand new to trading options, I don't care if you guys, you go 75 and 50 here, right? And then down here, you're like, you know, 25 and 15 or something like that. Okay, you can fudge those a little bit just to get into trading options and try and, you know, keep your risk parameters a little bit further away, because what happens is you can see what volatility does on any given day, and you can see these are moving by massive percentage points. Now, this is what I was talking about. Is GLD going to see that 50 mark up there anytime soon? I don't know. I tend to believe it's probably going to kind of trade, you know, in this area, really, to be honest, kind of like, you know, I meant to go a little bit lower there, but you get the idea. I think that extreme high after the pandemic is probably a little bit overdone, and I'm kind of believing that all of that down there, we're still going to see volatility in 2020. So for me, the reason why this current or that equation that I showed you guys with the current minus the low and the high minus the low, you know, this is where you would fudge it, saying, okay, well, the high is then here, the low is going to be here, and we know where the current is, which is never going to change because current is the current. But, you know, some of this stuff way back here, I don't know. But that's up to you to decide. You know, you can go straight with the what TOS in this case will give you in the option montage. They give you current implied volatility percent. I have it so you can put it over in the watch list. But, you know, I also have friends that only look at implied volatility for the last 6 months. Okay, which, you know, is fine also. I mean, if you're a shorter term trader, then that might be a better fit for you. Tom says, I've been seeing IB increase further away from the money recently, and it can. I mean, further IB increasing further away from the money. You're saying the further out of the money options are increasing disproportionately to the ones that are at the money? Because that's as volatility. Okay, and the reason why is the reason that could be happening is with these massive spikes in volatility. What happens is when you have a massive spike in volatility, what it's saying is these option strikes are now having a higher probability of being in the money. So you're also seeing those deltas really jack up further away as well. Disproportionately, I haven't really gauged that as much. It could very well be somewhat of a rounding error too, because remember, those things go out to several decimal points as well. So there can be some rounding errors that kind of happen into that, but I'd have to dig into that. I haven't noticed that necessarily, but it could be because as the volatility expands, those deltas are expanding as well. Probabilities of those strikes in the money go. But the thing here is, I want to take away from this, why does volatility matter in this regard, is we want to, you know, like I said, it wants to revert back to the mean, back to where normalcy is. And so when it gets overextended to the upside, we see that volatility come out and, you know, things calm down. And then we see these spikes in it and things will calm down. So you want to get it when it's spiking and you expect that volatility to calm down or come out of it. And even if you are directionally wrong and that volatility starts coming out of your premiums, you can start having a winning trade if you sold it when that volatility is high. Vice versa, you know, if you're buying premium down in here, you could see the underlying trending sideways. And as that volatility starts spiking, you could start seeing being directionally wrong and make money, which is what we want to take advantage of. So in this case, what we're looking at for implied volatility percent for GLD, and are you guys losing this corner over there? This is GLD anyway. I didn't realize it was off my, it must have gotten shifted on here. And I can't fix it for you right now, or at least I don't know how to without getting out of this. So one thing we could look at with this one is we've got the high. Let's call that high 50. I'm going to just round here. We're going to say if you wanted to take into account this low here, we're going to say the low is 10 and the current is 25. So we've got that. So what was my thing? We're taking the current IV minus the low IV and divide that sum by the high minus the low, right? High IV minus the low IV. So we've got 25 minus what I said, 10, divided by that sum by 50 minus the low, which is 10, right? So basically we then have 15 divided by 40, right? 15 divided by 40, which gives me 37.5. What was my rule? If it is greater than 30 for an ETF, which is GLD, then that is a green light, okay? So then, or that would be, if it's greater than 30, we're looking to sell premium. You know, and if I wanted to discount, like I said here, kind of draw this stuff and get rid of it, let's just say this is the low right there. So I'm going to say that's 14. Somewhere around there is 14, right? And I want to take out maybe, or maybe you'd want to leave in that high of 50. So we'll just leave the high of 50 in there because I can't really figure it out. We could probably do a 35 in there. So I could say the high is 35, let's say. So the current, in this case, we want to discount, kind of draw our lines there and there. I know it's getting messy. Let's say it's 35 is the high. So now we've got 25 minus the 14 and then the 35 minus the 14, right? Is that what I said? Yeah. So we've got 11 divided by 21. So we're looking at just over 50%. So, you know, that if you had a lower risk tolerance, that would fit that rule. If you're only looking at 60%. So any way you slice it, we can look at this being the fact that we do have some pretty elevated implied volatility across the board, right? So we've got some pretty high volatility across the board here, at least right now. And you can see we've just gotten a big snapback. So the market is making a move today. I got into this trade just a couple of days ago, just so you guys know that we're keeping score. So obviously we know we have high volatility, right? We've got somewhere, depending on what you're looking at, a 30 IV percent. IV percent is 30, or you know, in the other case, it got even higher at the 50%. So that means we are looking to sell some premium here. So is the strategy to be buy puts if the stock has run up too much and they expect a drop? Well, the idea here is you know, I mean, if you're bullish or bearish, right? If the stock's run up and you all of a sudden think, well, you know, I think this has run up too much and I think it's going to come back down. Well, now what you need to do is you've got a bearish assumption, right? That's the first step. If you believe it's going to pull back, you've got a bearish assumption. The next thing you need to do is look at implied volatility percent. If it's high, then you would probably want to sell calls for that bearish assumption. If it's low, super low, then you would be wanting to buy puts for that bearish assumption, right? Or sell a call spread or buy a put spread. You know, there's all kinds of different things you could do. You could sell, well, we haven't gotten to iron condors and stuff like that, but there's a perfect scenario for iron condors as well. But I don't want to get into all that and muddy the waters right now. But right now with GLD, with my assumption, right, I've come up with a bullish assumption. I didn't know what strategy I was doing. Now I've come up with high volatility. I know all the other things. So I've got high volatility. What do I want to do when I have high volatility? I want to then look at the duration. If I have high volatility, right, I want to spend the least amount of time on the road. I want to beeline it to my destination, right? So I want to have short duration on the road. I want to get the fastest path there. I'm probably going to take I-80 to 35 and get there as fast as I can if I wanted to really follow it right and do it like a AAA TripAdvisor. I want to get there as quickly as possible. I'll possibly take a helicopter or an airplane, but in this case, we're taking the road. So, but if I have to take I-80 and this underlying trade sideways, well, I still want to make money on my trade. If it trades sideways and then it goes higher, I want to take advantage of that high volatility premium. I want to get there as fast as I can. That means our duration is going to be very short, right? We're going to try and get there as quickly as possible. So I'm going to be using the shorter duration because I want to, when you're buying an option, the trader wants to limit theta decay. And when you're selling premium, you want to exploit theta decay. I should have changed that to sell it, exploit theta decay. So we can see this is another example of what theta does. This is all about the thief, right? This is our thief. The thief isn't very aggressive out here, but inside of this area, that's where he gets aggressive. That's why you keep hearing me talk about 35 days to expiration. Yes, this is the at-the-money calls. We're not necessarily going to be using the at-the-money calls, but you still saw on the option montage, theta is much more aggressive inside of 35 days to expiration. So I want to take advantage of that. Something else to note, when volatility is pumped into those premiums, right? We talked about that when volatility expands, what happens is conceptually, what happens to this line is as volatility starts increasing and decreasing, you can see it kind of does that to those premiums. If this line is a conceptual representation of what our option prices are, right? What happens is those premiums get pumped up. And then when that volatility comes out, it catches up to the curve. So it feels like that theta just comes out of it. It's really the volatility, but that's what happens to our premiums, and it catches up with all of that during that time that we were into this. All the theta is really, really coming out as well. So you get bang for your buck. You get that theta thief, or the theta thief coming in and stealing your premium. The volatility collapse or volatility crush is what we used to say on the floor. You get that all coming out. Well, in that case, I really don't care if I'm just going sideways along I-80, right? I don't care if the underlying is trading sideways. If I get that volatility coming out and that theta decay happening, well, I sold, or I'm looking to sell premium, right? To take advantage of that. So I want to look to sell the short put spread. Why? Why the put spread versus the naked puts? Because I'm worried about that downside. I'm worried about them not doing another quantitative easing, and the rest of the world does, and our dollar strengthens, and now gold all of a sudden starts falling out of favor. All right, so I do worry about the downside. So that's where the spread part of it comes in, right? You want to limit your risk to the downside. All right. Well, what spots are we going to visit on this trip? We're going to sell it out of the money put. I like to go to the 36 delta and then sell it further out of the money put. Why do I not have the delta on here? Well, because I don't know exactly what that strike is. Now, I do have a thing here where this width, so basically this is a spread, right? You're selling out of the money put, buying it further out of the money put. Well, that's the spread. What I want to do is I want my credit, because I'm selling a nearer outer one. You know that one that I'm selling is worth more. So when I get this spread together, I want to collect. I want my credit to be greater than or equal to 30% the width. All right. So it doesn't matter if you're using a $5, $4, $3, $2 wide spread, a $1 wide spread. If it's a $1 wide spread, what's the collection you want? 30 cents. So, you know, like 25, really it's 25. That would be the green light, right? 25% would be a yellow light. Okay. So somewhere between 25 and 30% the width of the spread. All right. So green light, you're collecting 30%. Yellow light is about 25%. All right. Red light would be anything less than that. You don't add in a penny for commissions. I don't really look at the commissions on it anymore. You know, when you do have to worry about that when you're only working with dollar wide ones. So that would make you lean to the 33% kind of thing, 33% the width of the spreads. But no, the more collection you have, the higher probability of success you have as well on that. All right. So one of the things we were talking about, why do I pick those strikes? Because that's basically on the put side. If this is the puts and this is the calls, right? Basically, we're looking at a half a standard deviation. Now, this is a perfect bell curve. We were talking about skew earlier, and there is no skew in this bell curve. They're equal distance. But if you basically add up the probabilities of all of this happening, you know, anything out here, that's about a 36% probability. Everything out this way is about an 84% probability. All right. So, you know, I'm selling a put spread because I expect all of this to happen. From where I've shorted, you know, you get in here. I'm worried that it might come down a little bit, but I expect anything out here to happen. All right. And I think it's going to stay above here, but I'm also, you know, I'm starting to get a little worried if we start breaking down below that, which could happen. I want protection. All right. So basically, we're looking at a half a standard deviation move. Now, if there was skew to the put side, then we would see the skew, and I'm going to try and not butcher this drawing. I did. That's not bad. Let me try and date it. If there's skew to the put side, it's kind of like that, all right? Where that's terrible. That's terrible. It's actually looking more like skew to the call side, to be honest. So basically what happens is, I'll try it one more time. Then I'm not going to waste time drawing. All right, so skew to the put side would be, I did it again. All right, so right there. That's pure skew to the put side. All right, I'll try and do there. That is skew to the call side. That, if I could flip it, would be a really good one. So you can see more happening over here on this side than on this side. Okay. So kind of a terrible skew line, but this is skew to the calls. That's a good representation. That's not a very good put one. All right. So that's why I'm picking those particular strikes. All right. So in this case, for example, when I was looking at this, I took a snapshot of this during the open market operations because sometimes the bid offer gets really wide on these. You can see, again, we go through the steps. It's over $100. We can see that the bid offer on the calls and the puts is good. That means that we've got a good location, right? Now, I've talked about the 36 delta. So I'm looking at the 179s right here. That's as close, you know, it's not always going to have a 36 delta, you guys. This case, it worked out well. Sometimes, you know, you just want to try and get as close to that 36 delta. Sometimes you're going to have to go a little bit closer, a little bit higher delta in order to get it to fit that rule of 33% the width of the spreads. But if we do this, I went $5 wide. You know, basically my rule of thumb is if it's less than a $50 stock, you're going about $1 wide. If it's right around a $100 stock, you're going, or $50 to $100 stock, you're going $3 wide. Basically over $100 stock, you're looking at least $5 wide. So in this case, you know, that's just a quick way to streamline your process of getting to that strike location. Couple of reasons why I'm picking the 36 delta. One, it's got only a 36% probability of being in the money. It also lines up with 36 delta is that half standard deviation away, means I've got 64. I wrote that wrong on that one slide. I said 84%. It's 64% probability of being on this one. This should be a 64%. Nobody caught that? We got 100%. This should be 64% to the upside. All right. So I've got great chances of everything happening above this area, right? We're right here. All of this can happen and I still make money. That means the underlying can go down and I still make money as long as it only goes down a little bit. All right. So I've got a 36% probability of it being in the money. That's pretty low probabilities of me being wrong. I've got a 64% probability of being right. That's one of the reasons. The other reason is it makes it great for your bang for your buck, right? 33% the width of the spread. This is right around that. Somebody can check the math on that, but I believe that is pretty darn close. So we've got $5 wide, collecting $1.52. That means my risk reward is I'm risking 1 to lose 2, which is one of those things that we have to put up with selling options. Why do I have to? Why is my risk reward? My reward is less than my risk. Well, it's because I've got a 66% probability of being right, or 64%. You know, depending on how you do the math. If you're looking at the bell chart, it's a 64% probability of being right based on the delta. If you're looking at the spread width versus the credit I'm receiving, it's going to be right around 66%. There's different ways to figure out those probabilities there. So I've got a really good probability of success, right? I mean, of being right. If you just went out and bought GLD on the assumption that it was going to go up, well, you only have a 50-50 chance of being right there. Here, we have all the way to here to be right, and it can go as high as that, and I'm a winner. All right? So, real quick review. Direction, we've got bullish to market neutral. Our destination, that's where we're looking at less than or equal to 10 cents wide from the bid to the offer, right? Or you move the decimal 3 ticks to the left, right? Our environment, we have high IV, right? That's our environment. Our duration then would make it want to go to 35 days to expiration, right? Strikes, we're going to go to that 36 delta, and we want a credit of 33 to 25%, all right? The width of the spread, okay? That means you're basically risking, or your reward is 1 to risk 2, okay? But you have really good probabilities here. You know, your 6% chance of winning is greater than 65-ish on average. Okay. So our max profit is the net premium received. That's that credit. So my max profit in this GLD is basically $1.52. All right. Our max loss is the width of the spread minus that premium, right? So I have $5 wide, $1.52 means $3.48. I know my risk. I know my reward because it's defined. And then our break even is the short put strike. So in that case, my 179 puts minus that premium received. So 179 minus $1.52, 177.48 is where my break even is at expiration. So even if it goes below 179 at expiration, as long as it doesn't go $1.50 below it, I still have that wiggle room as well, right? And that's all at expiration. You know, volatility can affect all these things as well. Volatility really starts expanding, you know, we could see ourselves losing money without this underlying going anywhere. The premium is going to go up. Then you just hold on to it. It's only, you know, it's only on paper at that point. If it's not moving anywhere, I'm not going to worry about it. I'm just going to wait for that volatility to come out and take advantage of that, right? Because we have volatility in our favor. We have the thief in our favor. Once all that stuff comes out, we know we're good to go. And all of these things I want you to write down. Remember that one where I showed you the gray where I kind of went through and wrote all those things down on the destination, the strike location, and all that stuff? Do that, you guys, especially if you're newer to options trading, because it will help you stay mechanical. And money is an emotional thing. You know, we're talking about fear and all of that stuff. Well, this is an emotional process. We've got to separate ourselves from that as best we can. And by writing these things down, you can see it on there and stay true to what you were originally believing. Now, if there's something that comes out and all of a sudden changes your mind, like, yeah, these yahoos do bolt and don't give a stimulus package, how is that going to affect the economy and everything else without, you know, I don't know how many people are unemployed right now, but it's like 10 million people that are relying on that. You know, there's a lot of people struggling right now. And if they just walk away and go eat their ice cream in their, you know, sub-zero refrigerator and their $1 million kitchens, well, you know, it is what it is. They're getting paid. So know your exit as well. Write this down, because if you have it in your head, you will not as likely stick to your guns as if you put it down on paper. You're holding yourselves accountable if you put it down on paper. And I know people say, you know, I hate it when you write everything down and all that stuff. Well, listen, especially when you're newer to trading, this is the best way to stay mechanical. You know, you have to separate yourselves from money or thinking money. So know your exit. And what I say, because it's defined risk, I'm going to take that loss, all right? On a winner, I'm looking to get out at about 50% of max profit. All right? And if you guys watch the daily market commentaries, you saw me do this with Adobe and Facebook just not too long ago, right? I got out at 50% of my max profit. I don't care after that. You know, the markets move all around. You know, a fool and his money are lucky enough to find itself. You know, I take my money and run. I'm not worried about hitting home runs, you guys. I don't care about the last 8 days of expiration and the gamma and all the money that comes out of your premiums. No, if I get that market move and I get the volatility coming out of selling this strategy, yes, I'm out. I'm moving on with my life. I'm on to the next greatest thing, all right? I stick with the guns on this. So in this case, I would be saying, and I don't care if you guys put in an order as soon as you get into this trade. You know, at $1, I got in at $1.52. That was my max profit, right? Well, then I'm getting out at about 75 cents, 76 cents. All right? You can put in an order almost immediately afterwards. That's my exit. I'm exiting at 76 cents. For XYZ's, you know, 179, I think it was 174 put spread. All right. On the loss, I'm probably going to write it out because I know it's defined. All right. But I have no problem with you guys going in there and you know, looking at the charts, which would be another thing that I might even look at with this one, probably because that's what I said I was gonna. You could look at it like this, and I'll just try and see if I can throw up a Fibonacci real quick. Just to, you're not gonna give me Fibonacci. Just kind of do it like that. You know, I don't have a problem. You know, it did cover this gap, which is one of the things that I stayed in on it. But you could say, hey, if it breaks below this 23, then I'm out, right? My 174 is right around here, so maybe you don't want to wait that much. But just say, hey, if it gets below the 180 and settles below there, then you're out, right? It already tested it. It covered the gap. You're bullish, all of those things, however you think. If we start trending sideways here in this underlying, and this just kind of starts going like this, right? And we get this volatility coming back out, say around there. Well, what is that equivalent to where I just drew that line? It's probably, let's call it 17. So we have 8 percentage points coming out of this. If the underlying didn't even move, and I get 8 percentage points coming out of this, right? And I'm selling this 179, 174. I've got 5 cents. I've got 40 cents coming out of this strategy, right? Because I bought one, I sold this one, and I bought this one. So the Vega is going to be affected on both of them, right? So the difference is 5 cents, which is 40 cents coming out of my overall strategy, right? Well, that means I bought it at $1.52, and if nothing else changes, you know, I haven't even talked about Theta yet. Theta is going to take a couple of pennies away from there. Well, if I just get that volatility coming out by 8 percentage points, I'm going to get 40 cents coming out of my strategy. That means it goes from $1.52 to $1.42, right? And that's just it trading sideways. So I can take advantage of that volatility contraction, volatility reverting back to the mean and GLD, okay? So I want to take advantage of that. When do you take a loss if your target doesn't hit? Well, in this case, if my target doesn't hit, being it doesn't rally or trade sideways, and it's $1, you know, if I'm gonna ride it out to the downside, or if it breaks that Fibonacci I talked about, right? But these are things I'm gonna write down. Like if I did this tomorrow for this strategy, I'd probably say if it retested this Fibonacci or wherever, I'd probably draw a better Fibonacci back or something like that. But, you know, for purposes of this, I'd say if it breaks below here again, I'm out, right, for a loss. And I would write that down. A settlement below, let's just say 180, I'm out. Okay? I'd pull the ripcord on it. But, you know, it's up to you guys to determine your risk parameters. I can't give you everything on like losses because it really comes down to your risk parameters, how much risk you're willing to take. You know, me, I have a high risk tolerance. So the last thing I want to do is give you guys what my risk tolerance out is if you guys have a lower risk tolerance, right? I don't want to do that to you. So determine that. If it goes below this Fibonacci, I'm out, okay? You know, trade sideways, I'm out 50% of max profit. Is a really good rule of thumb. If you have a higher risk tolerance, you can say 75%. I don't care. I have a high risk tolerance, and I like to swing for singles, doubles, and sometimes triples. I don't go for the home runs, all right, or the grand slams. I don't care how sure I am of a directional assumption. I never go all in. Most I'll ever allocate to any underlying or any directional move is probably 15% of my portfolio value. I don't care how sure I am. All right. Yes, of course, on stuff like Penn, where I bought it at $5 and just did a tranche of it. I wish I would have pushed all the chips in, but that's because hindsight's 2020. You know, if I pushed all the chips in there and it like fell out of bed, then, you know, then you lost it all. And that's not worth it. You know, our assumptions are only as, what do they say about assumptions? All right. So 50% of max profit is where we're looking to get out on your loss to the downside. If you have a higher risk tolerance, you're probably looking at that defined risk strategy and the probabilities, right? You're looking at the probabilities. It might go through the 179 and you believe my probabilities are right. I'm still right. The probabilities are just against me right now, but by the end of all of this, it's going to be hunky-dory. Well, that's kind of how I look at it, right? So write this stuff down. I can't implore you guys enough to do that. It will help you sleep at night as well. It'll help you keep mechanical. And if you can be mechanical, you will wipe out all of those fears and stuff. Cox, and put alerts in. Yes, absolutely put alerts in. Absolutely. Great call, Thomas. And you can put notes in those alerts and stuff like that so you can go back there and check it. You know, I use old school 3-ring folders that my kids, you know, didn't use all the paper at the back of them. I just pull out and use the rest of them. So I have a stack of 3-ring folders that my wife hates on my desk. But I write down all this stuff still. 25 years later, I'm still writing this stuff down. Why? For one, I can go back in time, and that's my back testing. You know, I go back and start looking at this stuff and figuring out, you know, the probabilities are still working. So yes, Thomas, absolutely, you can put it in your alert. And D was saying, are you saying that you might be out at 50% profit if it continues to go sideways, but hold for a higher target if the stock goes up? No, if I start seeing 50% of max profit or it's trading around 76 cents, D, I'm probably getting out of it. 90% of the time, depending on, you know, sometimes, you know, if I say, and it's going to be dependent on what I write down. It's going to be dependent on how I set the strategy up, right? It's all dependent on that. For me right now, I believe it's going to move higher to sideways. But if my target was, you know, I just looked at this and said, it's going 195, I see 195, I'm out, right? I think it's going to make those all-time high. I think, you know, 2000 is that target. Or, you know, you say 200. GLD goes to 200, I'm out. I don't have a problem with that. But what I want to implore you guys to do is if that is what you're saying, write it down because that will keep you mechanical, all right? Below 180, I'm out. 120, or 200, I'm out. You know, if it goes up to 200, you're probably looking at that 75% of max profit. All right. For me, I say 50% of max profit, and I usually stick to that across the board. Now, if I open up tomorrow morning and, you know, or, you know, I put this trade on, let's say Friday, and Monday we come in and it's trading around, you know, 70 cents or something like that. Well, I might not cover it right then, especially if it's just blasting off, but I am going to hold on to the fact that I am not going to lose that 70 cents to get out, right? I might squeeze it just a little bit, but I'm not going to just be like, hey, you know what? I'm a winner and it's just going to keep going. No, I'm pulling the ripcord. I know I've beaten the probabilities in that case. And when I beat the probabilities, I'm out, right? I'm not afraid to be the guy that goes into the casino, sits down at blackjack, gets, you know, doubles down on eights, gets 2 aces on my eights, and the dealer, you know, gets 15 or whatever, or busts. I'm not afraid to just take my chips and be like, I'm going to the next table, right? I look at it like I just crushed the probabilities. I'm taking that money off the table and I'm walking off, right? Because I knew sitting down, the probabilities were like in my face and I just crushed it. Right, that's like a home run. You get 2 eights and you get 2 aces on top of it, and the guy busts as the dealer or whatever. I'm out. So that's how I roll. But it's kind of up. I can't tell you guys, you know, you might have a higher risk tolerance than me. You might play your trades a little bit different where you got a price target. I have no problem with that. I'm just kind of giving you guys that part of the in and out on your entry and exit for a winner or a loser is a bit of a gray area because of the risk parameters that you may or may not have. All of the other stuff, though, we're playing probabilities. I'm telling you the probabilities. Those are facts. Those are what we need to stick by. High volatility, premiums are expensive, right? High volatility, premiums are expensive. We want to sell. Low probability, premiums are cheap. We want to buy, right? The last thing you want to do is sell premium when implied volatility percent is trading around 12. I don't care what the boys on CNBC are telling you. When implied volatility is at 43 ahead of an earnings and somebody's telling you to go out there and buy calls on a bullish assumption, you know that guy has no clue what he's talking about. After an earnings, I can go and show you after an earnings, what happens after an earnings. Volatility crushes almost every single time. Well, this is a bit of a bizarre one because it still got crushed a little bit, but that was, you know, that's an outlier. But, you know, we can look at like Apple. You can see that Apple, after earnings, we get volatility coming out. Volatility coming out. Volatility coming out. Why would you want to buy calls ahead of an earnings? Right? Sorry. It's one of those thorns in my sides. All right, you guys, I'm not going to keep you guys around too much longer. Here is the link for the chat, for what's in the chat window. I'm going to send it out there. You guys can click on that link. That is for this options course for earnings. We're in the thick of earnings. I also have them for, you know, the stocks that have already had earnings, right? We're going forward. You can play. I have strategies in there to play up for the next earnings as well. And this is to help you avoid some of those pitfalls that those guys on TV are talking about for earnings. These are my specific rules or guidelines for earnings. They're a little bit different than what we've been talking about for these trades here. I have some different days to expiration and strike locations, stuff like that. So you can take advantage of that by clicking on the chat window. If you're on a tape delay, you need to punch this into your URL. So I go through all of the best option strategies for earnings in this and for setting up for the next earnings cycle there. All right. So like I said, over there in the chat window is the hot link that you can take advantage of. And finally, I want to thank you guys all. Later webinars, I'm going to drill down on different option components, when and where I'll find those. Also, here is the link again. You know, the best thing you can do to support us here, if you like what I'm doing, if you learned anything at all, take advantage of one of these. You know, you will learn something new going forward, and it will help you. For 36 bucks, you guys, if somebody told you to buy a call ahead of an earnings and you went out there and followed suit with that on your underline, you could have been directionally right and still lost more than that $36 by doing that. So, you know, $36 is pretty cheap in comparison to what you'll learn. All right. And avoid those pitfalls that somebody else is going to set you up for. Also, if you have any questions, 310-598-6677 or trading@protraderstrategies.com. All right, Thomas already left. He said thanks. All right, thank you, Thomas. And everybody else, thank you. I see people are popping up with the kind words. Appreciate that all, you all. Take care. That's all I got for you, other than one other thing. Some people are leaving before the disclaimer. Make sure you know the risks involved. I'm not trying to get you guys to living off the cliff. Take a moment to pause this video and read over this. Finally, if you can't take that, take it easy.